Can a profitable business fail because of cash flow problems? Believe it or not, profitable companies actually go bankrupt almost every day, and I'm about to tell you why. Your profit and loss statement says you made 200 grand, but you look in your bank accounts and it says zero. What happened? By the end of this video, you're gonna know which of the 3 cash flow traps are actually putting a stranglehold on your business. You know, everybody wants a profitable business. I want a profitable business, you do too. But we actually need to ask the question, what is profit? Now, this isn't some frou-frou thing to go, hey, profit's internal, it's inside of you, bro. You know, kind of this levitational whatever. No, profit actually ties to monetary value, but it ties to a lot of other value as well. I do think it's important that we identify what profit is so that we can understand how to properly go after it. If you actually do a deep dive into the Latin root of profit, it's a word called professare. I don't know if I'm saying that right, but it literally means to advance. And I love that concept about this idea of profit. Why? It's because profit's like fuel in the tank of a car. The car can only advance if it's got fuel in the tank. It's really hard to advance unless it's sitting on a down decline without fuel in the tank. And so that's what profit is for our business, the idea that it allows us to be able to advance. So where there is no profit, we can reasonably say there is no advancement. And there are a lot of for-profit companies that are running like nonprofit entities. I'll never forget the time I was talking to an architect in North Carolina, and we were walking through the coaching process, and he had been running his firm for about 28 years. And we got to this idea of cash flow and subdivided bank accounts and some of the things that we teach. And he sort of went white in our coaching meeting. And I said, hey, John, what's going on? He said, I just realized I've been running a nonprofit architecture firm for 28 years. You're like, how does that happen? Well, because a lot of us are just cash flowing a lifestyle through the business rather than actually leveraging profit for the business and trying to drive towards that. So when we talk about profit, there are a couple different profits that we need to identify. A lot of people use the term gross profit. What is that? It's what some people would call real revenue. It's basically your total revenue minus your cost of goods, your cost of sales, which means if you didn't have sales, you wouldn't have those particular costs, but there are other expenses in the business that if you didn't have sales, you would still have to pay rent, to pay internet, to maybe pay some key personnel or whatever. And so gross profit for a lot of people means your total revenue minus your cost of goods, but you still got to pay expenses out of that. Now, another version of that is what we call EBITDA profit, E-B-I-T-D-A, EBITDA. And what does that mean? Earnings before interest, tax, depreciation, and amortization. Basically, it's your net income statement before you pay anything else out of that, like your taxes, to those sorts of things. And then what we have is we have a true netted out income or net profit. And what that means is once you've paid everything out, here's literally what's left over at the end of the day. And so when we talk about profit, you really do need to identify what profit are we talking about. Now, what gets in the way of a profitable business, what we're talking about, there are really 3 traps that we need to identify and begin to work our way out of. Trap number 1 is we tend to mistake paper profit for bank account profit. Now, what is the difference between paper profit and bank account profit? Profit on paper, we look at money in 3 forms, past, present, and future. So basically anything that's in the past, balance sheets, P&Ls, cash flow statements, is anything that you can fundamentally print out on a sheet of paper because the moment you print it, boom, it's stuck. It's now in the past, right? Because it's ink on a piece of paper. And so then money flows in present. That's what's actually in our cash accounts, and we like to subdivide those cash accounts anywhere between 6 to 10 different cash accounts in one particular business. Yes, even if you're 1 employee, 5 employees, 500 employees, we want to see subdivided bank accounts so that when the dollars come in, we can metaphorically cut those dollars up and put them in unique homes. Why can't we do that on a spreadsheet? Because it's a psychological game to be able to see it all subdivided into different sub-accounts as to what that looks like when you log into your bank account statement. So when we talk about paper profit, we're talking about basically anything that you can print. So when your CPA calls you and goes, hey, congratulations, you made $200,000 this past year, and you look at the bottom of your P&L statement, it says $200,000, but you look in your bank account, and you don't see $200,000 in there, that's what we call paper profit. It's a little bit frustrating if you think about it. It's cool for ego and it's cool for tax payments, but that's about it. And sometimes obviously we can use it when we're doing succession planning or exit planning to be able to sell the business. But it's still paper profit. What we're going after and trying to help you solve is actual cash profit in the business and what you're looking for. And so that cash profit is what we would call bank account profit. So paper profit, bank account profit. Bank account profit is at the end of the year, you actually have a bank account called profit and you've been sweeping money into that all year and it's staying there. You're not having to use it for other expenses and to overcome, not enough cost of goods or whatever. And then what's in that account at the end of the year is your actual profit. That's actual cash that you can actually use for the things you actually want to use them for. So trap number one is being obsessed with the paper profit, but not focusing on the bank account profit. A little side note around that. A lot of businesses are being encouraged to do accrual accounting versus cash accounting. And so you might ask, what's the difference? Well, accrual accounting, we actually call it accrual accounting. CPAs, IRS, they love accrual accounting. Why? It's because accrual accounting is kind of like an RSVP list for a party. It tells you who's acknowledged that they're going to come, even though they haven't come yet. Whereas a cash accounting is the party itself. It's the people who actually showed up. So you know what the party is because the people are actually there. You know exactly how much food to serve, how much drink to serve, all of that because the people are standing in front of you. That's cash accounting. Accrual accounting is you get all your food and all that preparation based on who said they're coming. So that's the difference between the two. Why do a lot of people, small businesses, use accrual accounting and their CPAs do it? Is because that's what the IRS looks at so that we can pay our taxes off of it. So beware of trap number one, is mistaking paper profit for bank account profit. The second way that a profitable business can fail even while generating cash is they're not getting paid fast enough. This is such a big emerging issue and it doesn't need to be. There are so many tools and technologies to be able to solve this problem. But the reality is a lot of us are afraid to become the collector in our business. The reality is you have provided a service for a fair fee. And you need to be paid that fee within a timely manner because if you don't get paid that fee, you're then going to move to other measures that are going to start to introduce disease into the system. In fact, it's why you've got the profit challenges that you've got right now for many of you, is because you've had to go out and get lines of credit. You've had to borrow from friends and family. You've had to borrow from other client deposits that are whatever. And we need to stop using tomorrow's money to pay yesterday's bills. In fact, that's a good litmus test for you to think about. If you're ever having to rely on the next payment, the next deposit, so that you can go back and pay yesterday's bills, that's an alarm bell in the business to let you know that you're about to fall in this trap. And you can still go out of business while showing profit on paper. So what's one quick way that you can solve this? Work on the terms of your payment and also work on automating your payments both out and in. So you might ask, why is automating payments out such a big deal? Don't I want to hang on to my cash longer? No, not necessarily. Many people think I want to hang on to cash, I can gain interest and all that, but most of us don't do that. And what we end up doing is reserving our payables longer and longer and longer so we're more and more in debt. Let's get the cash out and let's get the cash in. We need to start working on our terms. Some of you are in industries where the terms are the terms. It's 45-day payment, 60-day payment, paid when paid, whatever that might be. Well, if that's the case, you've got to start maneuvering your business model around whatever those terms are, or start getting creative about going to some of your vendors and going, hey, I know you said 60 days, but is there a way that we could do a rebate if we drop that down to 45 days? If you don't ask, you've got no shot to doing it. And as it relates to automating your inbound receivables, we've got to start using things like credit cards, ACH, automated electronic payments so that you can get your money fast. And I want you to be creative about this. Have you ever thought about offering a discount if they pay by credit card? Whoa, Scott, what about the 3% fee and all that kind of stuff? Well, work that into your fee structure and then offer them a discount if they pay with credit card, because you getting the money today within 3 days, 7 days, 10 days is way better than you waiting 45, 60, 90 days in order to get that money. And you would gladly take a reduced amount to get the cash right away. But make sure to work that into your pricing. So we've got to be efficient in bringing our money in and getting our money out so that we can come in and out. By the way, that's how money works. It's part of the money behavior of money. Is it needs to flow. Money is designed to flow. The federal governments around the world want money to flow. They want to unlock that. That's what keeps economies going. And so it's better not only for you, but it's better for your community and your economy if you can get money out and get money in much, much quicker than what you're doing right now. And it'll put you in a position to be profitable so that we can see some of those alarm bells before they happen downstream. Trap number 3, we operate under a false philosophy. And here's the philosophy. You ready? If there's money in the bank, I must be making money. That is not true. There are plenty of businesses that we have seen that there is money in the bank, 6 figures, 7 figures, 8 figures of money in the bank, and yet they're not making money. I'll never forget the story about the big business WeWork. You might have seen some of their buildings and their office spaces in big downtown metropolitan areas around the world. And it was a co-working concept that they had sprawled throughout the world. And there was a documentary done about it. And it was a pretty messianic figure who was leading WeWork at the time, raising money and drawing people around the world and doing these radical things and talking about it's not co-working, it's a lifestyle and all this stuff. And I'll never forget, in the documentary, he was at a board meeting with super high-powered board members, names you would know that are on this board. And he said, I've got great news. We're generating $1.9 billion a year. And one of the board members spoke up and said, yeah, but we're spending $2 billion per year. There are a lot of you that you're generating revenue, but you're spending more than you're bringing in. Now, you might not be spending more than you bring in overall, but the way that the cash is flowing. So be mindful of those three traps, and also be mindful of a free gift that I've got for you that will help you solve those cash problems. So if you go to solvecashflow.com, just click on the link in the description below. It'll take you to a special tool that our team has built for you to be able to walk through so you can do different strategies like subdividing your bank accounts, getting money in and out a little bit quicker, how to track those cash accounts so you understand the historical flow of cash within your business, 3 months, 12 months, 24 months, and what that looks like. This is better than a traditional cash flow statement that is outdated the moment that you print it. So go to solvecashflow.com and we can help liberate you from the chaos of living with an unprofitable business.